Well, I think investors should realize that in 2021, we had the fifth lowest volatility on record, down 5% drawdown
Wow.
maximum. And in 2022, we're expecting as the Fed pulls away the punch bowl to have more volatility. So at this point, what we're doing is we're sticking with our overweight in growth over value. And that's not zero coupon growth stocks. These are what you just referenced, the large cap tech stocks. And in addition, a lot of names that are cash flow generators, companies that are deploying their operating cash flow back in the business or returning it to shareholders. And we think those are the barbell, that's a barbell strategy, which will be opportunistic in 2022.
All right, so it doesn't sound like, Richard, because Apple is on your list, that you are that concerned about what Morgan Stanley just said could be a market risk. You don't sound that worried about that idea that a few big stocks tend to control everything, and if they go down, there's almost no way the entire market might be able to go up.
Well, think about it. If half of the capital going into the stock market is through indexes, and you have the S&P is the largest one, and these companies represent roughly 27%, 30%, depending on what you're including in the S&P. So if an investor is underweight these names relative to that percentage, and these stocks do well, they're going to underperform. So by virtue of the fact of being large and the advent of indexation, we're seeing demand for these names. In addition, they've had a steady decline in beta over the last 20 years. They have large moats around their business. They're generating copious amounts of operating cash flow. Their CapEx is annualizing roughly $130 billion a year. Their revenues, their operating cash flows are growing faster than the overall S&P. We're now seeing the millennial generation, which is the all digital generation coming up. The work from home and work from everywhere is only benefiting them. And so there's just a host of reasons why these names will continue to grow and thrive relative to other names in the market.
The runner-up, you won the fourth quarter competition. The runner-up, Stephanie Link, up 10.5% in the fourth quarter, also a very good return. Yesterday talked about Cisco Systems. Richard, as I understand it, that's also a name you like. They used to be, by the way, we forget, the largest company in the world. Back in 1999, they were the Apple, if you will. Seems quaint to think about it now. What is it about Cisco that you still like?
Well, I'm in great company with Stephanie, the chief investment officer of Hightower, and I'm glad we both like the same name. But look, Cisco's a transformational company in the sense that they're moving from really one-off hardware sales to a subscription model. So by 2025, roughly half their revenues will be subscription-based. It's a $270 billion market cap, 2.5% dividend yield, but they have a 6% operating cash flow, which is relatively high, and deploying that in the most efficient uses. So Cisco's got a long road ahead of them. It could be owned for several years in this transformational period, moving from, sales into more subscription services.